Welcome to the deep dive. So, today we're going to get into the very nature of value itself, how it's being created, how it's captured, and how it's protected in a world that is just obsessed with proprietary insight.
Right. And we're looking at two complete extremes. You have the lightning fast world of high finance on one side
And the deliberately slow world of high art on the other.
and the core tension, as our sources really show, is speed. I mean, trillions of dollars can move in milliseconds, but the most critical decisions, these huge M&A deals, they still move at a crawl.
All because of manual analysis.
Yeah.
And that friction, that's where opportunity is lost. For you, or for any company really, the cost of just standing still right now is far, far greater than the risk of making a bold move.
It's become a structural ultimatum. You either find a way to integrate AI and leverage all its efficiencies, or you're going to be acquired by someone who already has.
That's the AI imperative you hear so much about.
Exactly. And it means that despite all the macroeconomic headwinds we see, high interest rates, geopolitical chaos companies are still aggressively pursuing M&A. It's defensive. It's about survival.
So, our deep dive today is going to analyze these trends reshaping the M&A landscape, from a massive liquidity squeeze to totally new operational models,
And then we're going to pivot sharply.
to the ultimate case study in physical scarcity, a high-stakes valuation of a unique collection of Salvador Dali sculptures. It's all about that idea of uniqueness, whether it's in code or in bronze.
Okay, so let's start with that structural reality.
Right. Despite all the volatility, the global M&A market is, well, surprisingly resilient. Aggregate deal value worldwide actually went up by 10% in the first 9 months of 2025.
But that figure can be a little misleading if you don't look closer.
At which deals are getting done.
Exactly. The total number of transactions is down,
Mhm.
which tells you that only the biggest, most strategic bets are actually moving forward. We saw mega deals, those over $5 billion. They increased by 15% in value.
So a flight to quality and scale. Only the most essential acquisitions are getting funded.
Right, but this resilience exists alongside a really deep paradox. Our sources are calling it the market of trapped value.
The great liquidity squeeze.
On one hand, you have a record $2.5 trillion in uninvested capital, what the industry calls dry powder, just sitting there.
But on the other hand, the money being returned to investors, the distributions, are falling way down to negative 11% of net asset value.
And this is the central tension in private markets right now. You have these huge pools of cash ready to go, but the general partners, the GPs managing the funds, are holding on to assets longer than ever before.
The average holding period is now, what, 8.5 years?
8.5 years.
Why are they holding on? It seems so counterintuitive when there's $2.5 trillion just waiting to be deployed.
It's a classic behavioral tension.
Yeah.
GPs are, well, they're reluctant to sell assets at lower valuations than they hoped for. That would crystallize losses or cut into their performance fees.
So they just wait, hoping for a market recovery to get those higher multiples.
But that creates a historic backlog. We're talking over 30,000 portfolio companies that need an exit. And the limited partners, the LPs, pension funds, endowments, they need their capital back.
Okay, so if traditional exits are sluggish, IPOs are rare, corporate buyers are cautious, but these mega deals are still happening, what's the financial engine keeping it all moving?
That's where private credit comes in. And this is a truly systemically important shift.
Its growth has been astronomical.
14.5% year over year for a decade. It operates outside the strict regulations of traditional banking, so it offers much faster decisions, more flexible terms.
So when a big PE sponsor needs capital fast for an AI acquisition, private credit is their first call.
It's the fastest, most reliable source. And that speed is critical because GPs have to get creative to generate liquidity for their LPs.
Right, since selling assets the old way is tough, they're turning to these alternative strategies.
Exactly. You see a lot of sponsor-to-sponsor sales, where one PE firm just sells to another. Or, more complexly, they're using what are called continuation funds.
Wait, break that down for us. A continuation fund. That sounds a lot like the GP is just selling an asset to themselves.
That's essentially it, but it's a legal mechanism for liquidity. It's a partial exit, where the GP sells a really promising asset from their existing fund to a new fund that they also happen to manage.
And this lets the original LPs choose.
Right. They can either cash out, sell their stake, and get their money immediately, or they can roll their investment into the new fund for a potentially longer, higher return ride. It's a way to unlock capital without touching the public markets.
It's a clever mechanism for sure, but you also have to factor in the rising execution risk. Regulators are watching all of this very closely.
Antitrust scrutiny is definitely rising, particularly in the U.S. And it's targeting that common roll-up strategy, the serial acquisition of smaller companies to build market share.
Regulators are worried it stifles competition.
And you see this globally. Australia, for instance, is bringing in a compulsory merger regime in 2026.
And what's so impactful about that Australian regime?
It's the low filing thresholds. That means a lot of relatively small bolt-on acquisitions, the kind sponsors use constantly, will now need mandatory government review.
So that just dramatically increases the cost, the time, and the risk for deals that used to be simple.
The regulatory barrier to scale is getting much higher.
Okay, let's shift gears now to the heart of the matter. This AI imperative and the new operational playbook. If firms are paying these huge premiums, it's to capture the margin that AI unlocks.
And our sources lay out three main paths for founders and investors looking to monetize AI. The choice here really determines how defensible your business becomes.
The two obvious paths are the extremes, right?
Right. Path 1, sell the software. The traditional SaaS model, you offer an AI co-pilot. It's fast to market, but it really depends on your customer being willing to change their own organization.
And path 3 is building from scratch. A fully integrated AI native company. High risk, high reward.
But it's that middle path, path 2, that's getting all the attention.
The buy and modernize or AI roll-up model?
Yes. This is where it gets really strategic. You acquire an established cash-generating business, something maybe a little boring, and then you embed your proprietary AI directly into their operations.
So instead of trying to sell a new tool to some slow-moving giant, you just buy the giant.
And you rebuild the engine from the inside. Exactly. This strategy maximizes customer lock-in because the end customer just sees the service they already use getting better, faster, cheaper.
It's inspired by that Constellation software model, right? Acquire, embed best practices, and just hold forever for compounding growth.
That's the playbook. And you see it in these vivid examples. Metropolis raised billions not to launch another parking app, but to acquire SP Plus, the largest parking operator in North America.
They realized buying the incumbent was easier than selling software to every garage manager.
And the same logic is being applied everywhere. Long Lake is buying up HOA management companies, planning to retrofit these established cash-heavy businesses with AI for all the back-office work.
The justification for the valuation all comes down to auditable cost savings. Our sources actually quantify this.
The numbers are staggering.
AI-enabled contract review can cut analysis time by 60 to 80%. And for overall M&A due diligence, professional hours can drop by 75%, from maybe 40 hours down to just 10.
A huge efficiency gain.
It is, but this is where I start to get skeptical. The big fear with AI is liability, specifically hallucination. I mean, if I'm a deal maker and the AI says a company's revenue is $500 million, but just made that up, I'm liable.
And that's the key technical challenge. So they mitigate the risk by forcing the AI to show its work. The first strategy is called grounding.
Grounding.
You ask the AI to retrieve and cite the revenue figure from a specific document, a specific PDF, rather than just letting it synthesize or invent the data.
And the second solution was something called chain of thought prompting.
Yes. We saw a great case study with an AI deal qualifier tool. To stop it from giving these confident but totally wrong verdicts, the model was forced to perform what's called negative inference.
So it had to explicitly list all the missing information, like detailed financials, before it was even allowed to generate a verdict.
Exactly. And then the verdict might be something cautious, like go with caution. It forces transparency about the data gaps, which builds trust with the user.
So the ultimate long-term value, the thing that creates the billion-dollar moat, is capturing what they call the digital exhaust.
That's it. Every time a user accepts or rejects a deal suggestion from the AI, the system logs the reasoning in a triage log.
And that's proprietary training data that no one can copy. That log, that record of human judgment, is then used to train smaller, specialized proprietary models.
You're creating a unique, ever smarter knowledge graph of capital. That is your defensive moat.
But the global playing field here is still very much in flux because of governance. The approaches to AI regulation are just so different.
Absolutely. In the U.S., the approach is highly distributed. It's focused on fostering innovation, removing barriers. The EU's AI Act, on the other hand, is comprehensive. It's focused on high-risk AI systems.
Things used in, what, critical infrastructure, employment, credit scoring?
Exactly. And the impact of the EU Act is expected to be significant compliance costs, the documentation, the testing requirements. For investors in those sectors, analysts are predicting a potential chilling effect on investment.
And just to even get in the door with these big institutional partners, tech providers have to offer a security pledge, right?
It's non-negotiable. They have to guarantee that customer data and private conversations will not be used for training the core underlying AI models. Your customer's digital exhaust has to remain completely proprietary to them.
Okay, let's make that hard pivot now. We've been in this world of infinitely duplicable code, where network effects create value.
Now we're moving to a realm defined by absolute, unrepeatable physical scarcity. The high-stakes valuation of a collection of Salvador Dali's sculptures.
It's a perfect case study to contrast with the digital moat.
A proposed $10 million valuation for this collection is ambitious, but it relies entirely on proving that it is singular. It rests on three crucial pillars.
So what are these pillars of singularity?
First, uniqueness. The collection includes a sculpture called Trajano, which is identified as a true one-of-one. No commercial edition was ever produced.
So that allows for masterpiece pricing. It's less about the metal and more about the historical importance.
Right. The second pillar is the matrix premium.
The matrix premium.
Yes. Many of the silver sculptures are legally defined as the matrix or piece zero. These are the initial reference standards used to create all the later commercial editions.
So because they're the prototypes, they command a huge multiplier.
A huge one. 5 to 10 times the value of the mass-produced versions. The closer you are to the artist's original act of creation, the higher the value.
And that brings us to the third and, I think, most poetic pillar, the biological link.
Which refers to the survival of 3 original wax models in the collection. These wax models are the primary artworks. They preserve the exact surface Dali modeled with his own fingers, his own nails, before the casting.
They literally hold the physical trace of genius.
That's the argument.
The specific detail about the Trajano Joven wax model really makes the case compelling. Tell us about that.
Right, so the Trajano Joven model is a great example of accidental rarity. It was preserved precisely because its internal wire core made it unsuitable for direct casting.
So they had to create a separate mold from it.
A separate silicone mold, which means the wax model itself was never destroyed or melted down, which is what usually happens. So that exceptional originality, the literal artifact the artist touched, is why its market value is considered higher than even the final cast pieces.
Of course, we can't talk about Dali's sculptures without addressing the elephant in the room.
Historical skepticism.
The art world has a long, troubled history with what people call the Dali sculpture mess. Questionable editions, fakes.
That is the ultimate risk in valuing this asset. So the mitigation strategy has to be all about transparency and authoritative backing. The collection's defense is its documentation.
They're emphasizing that these are the original artist's proofs from Dali's lifetime.
They're leveraging that biological link and the matrix premium to preemptively answer any authenticity questions that come up.
And while the Dali Foundation doesn't issue formal economic valuations, their involvement, their willingness to provide documentation is the essential layer of risk mitigation.
They're verifying the historical context, if not the price tag itself. It's like they're creating an undeniable historical chain of thought for the artwork.
Just like the AI models have to create a verifiable chain of thought for a deal, trust is paramount in both worlds.
Exactly.
So this deep dive has really explored value creation in 2 extreme forms. In finance, you have this proprietary knowledge graph of capital created by an AI that gets smarter with every single user action, the digital exhaust.
And the goal there is to maximize the speed and the infinite duplicability of that intelligence.
And on the other side, you have the unrepeatable physical form of a unique artwork, defined by the biological link, the literal trace of Dali's fingers in the wax.
Where the immense value is created by the sheer impossibility of duplication.
The fundamental conflict is just so stark. Private equity's future depends on accelerating processes and maximizing those digital network effects. The art market's value depends on defending scarcity and slowing down time.
And this choice, for you as a capital allocator or even just a consumer of information, becomes central to the future.
So as AI makes nearly all information instantly accessible and infinitely duplicable, what asset class will ultimately hold its value better in the long run? The data network effects driving a billion-dollar AI moat, or the singular piece of material that holds the physical trace of genius? That's the question we'll leave you with.